All right, we're going to get started. This is being recorded, so if any of you have to jump off, just know that we'll send you the recording in a couple days. Tonight, I'm here with Mr. Charles Green, who is the Senior Vice President of Harvard Small Business Finance. Hi, Charles. How are you?
I'm good. I'm good. How are you doing, Dani?
I'm great. I thank you so much for joining us tonight. I'm often in many of my consultations and webinars and stuff, I'm asked about money and how to get financing to start or grow childcare businesses. And I usually, since I met you last year at the conference that we were at, I have been referring all my clients to you that ask questions about money. So I'm grateful to have you on my platform now where you can share, some ideas and experiences that you've had and what other providers can take advantage of. So thank you for being here.
Thank you for inviting me.
Charles, like I said, he is the Senior Vice President for Harvard Small Business Finance, which is a seasoned small business finance professional with over 40 years of experience in creative small business capital solutions. So I'm excited to have him here. I'm going to allow him to share his screen. And towards the end of tonight's webinar, you guys can have some free time to ask questions. So please use the Q&A box that is at the bottom of your Zoom screen so that you do not forget what you might want to ask. I don't believe, Charles, if you do see certain questions in the chat or the Q&A box that you want to answer right away, you can. But if it's going to interrupt your presentation, don't worry about it. We'll get to it towards the end, okay?
Very good.
Okay, so whenever you're ready, you can get started.
Okay, well, thank you everyone for joining us tonight. I'm going to have a kind of a general overview about financing to share, I guess, some, let me get this screen a little bit neater, see it better. Talk about some of the products and options and uses of capital and how you might access it for different ways, different reasons, and from different sources in your business. And glad to take questions with this full-size screen. I don't know that I'll catch a visual on the chat room, but even if we run out of time or you have to leave early, I will respond to those questions if you'll put them in the box or wait until we've got that part of the session. So financing solutions for the childcare business. What I'm going to be talking about, sources where you can find funding for your business operations, the different types of financing products that are available, lending terms you should expect to encounter when dealing with different kinds of different sources of funding and for different purposes, and how to prepare for third-party financing. Third-party financing, of course, is when it's someone other than you. But I start out the first topic of the sources to remind you that you or your savings are probably the best, most reliable source of funding you have. And I'm sure most of you have started out that way, using cash you had on hand, some savings. Maybe you got some advances from family, which you'll find are going to be the toughest lenders you have in terms of keeping an eye on you and second guessing everything you do. But where possible, to the extent you can fund your own business enterprise, it's always the best because you're probably more careful and thoughtful about using the capital that you have previously earned and saved, and you use it more conservatively than, say, an EIDL loan, which may have come to you and your business in the last 6 months. It's sort of like manna from heaven. And I've seen a lot of clients not quite using that as prudently as perhaps I wish they would. But it's easier to do that when it comes to you too easy. And if you are putting up your own capital, sometimes you're more careful and thoughtful about it. Banks or bank business finance companies are probably the second most common place where people think about getting capital. Lots of banks out there, and which ones to go to, who knows? They're all have their own story, their own model, and a lot of times you may or may not get what they intend based on who you walk up to and who deals with your credit. It is a complicated sport to make commercial loans, and there's so many reasons that people fail um, to get financing approval. And I'm talking about qualified people who ought to get a good loan. It could be just the branch that you are served by, or the personalities in that branch, or the experience of the lender you get referred to, or the business model of that lender. So don't be discouraged. Often it's them, not you. Um, Sometimes banks don't lend money, or they tighten up their standards because they don't have cash. They're not liquid as they want to be, or they've had problems with their own decisions in the past that have made them shy away from certain kinds of credit. And that doesn't necessarily reflect on you or the opportunity that you present to someone. When I say business finance company, I am referring to companies like my company, which is Harvest Small Business Finance. Harvest is a commercial real estate finance company that holds one of 14 licenses held by non-banks to make SBA guaranteed loans. So we operate just like a bank, except we don't take deposits, and that we get our funding elsewhere. But there are lots of other kinds of finance companies for business, and we'll talk about some of those a little bit late in the program. Some you should avoid, and others that can perhaps provide opportunities for you. There are private investors, and I hear a lot of people. I've fielded lots of questions about people looking for angel investors who invest in child care centers, and I'll give you a hint. Angel investors don't. Qualified investors who are making investments in typically technology startups or companies that have a very large national or international growth potential aren't going to be a candidate to finance your business on your corner in your town. They are looking for a much bigger return and someone who can grow exponentially in a very short period. Your company is limited so far as growth by the size of the license that you have at a particular location, or how many locations you can aggregate, which are all limited to that license. But private investors in your situation might be a family member, a friend, or someone in your community who um, is interested in making a return that's a little unusual. It might be someone who owns property, who would let you come in and start a child care center in that facility in exchange for a portion of the profits in lieu of rent. Lots of people with lots of different appetites for small business investing. So that generally takes a very quiet search, and someone who may even approach you before you would approach them. It's hard to find private investors if you're, they don't answer ads in the paper, and you wouldn't want anybody that did. They are typically referred person to person. So if that were something that interested you, somebody who might have an interest in investing in a company like yours, you might talk to your lawyer or your accountant or your banker to see if they might know parties who are kind of on the hunt, because that's what they're looking for, is a screening person who can sort of vet you before they're recommended to speak with them. So I wouldn't place a lot of time in that effort unless you just have friends of friends, and you might be lucky to do that. But it's not often that people invest in smaller companies, such as a freestanding childcare center. And then another final source of funding I would talk about is what I call dark money. Dark money is a lot of typically online lenders who provide what's commonly called merchant cash advances or advance funding. They aren't really lending money so far as the law is concerned. They are advancing money against your future revenues. If you accept credit cards, it's likely that you've gotten a phone call before from someone, or maybe a recording saying, hey, do you need $100,000 or do you need $250,000? Um, there's an old saying, if it sounds too good to be true, it probably is. And that's the best thing I could say about this world. I wrote a book about fintech or online companies that lend money. Uh, I wrote it for the banking industry, called New Small Business Finance. It's um, it's a pretty interesting business model, but it's done outside of lending per se, so that they don't have to abide by limitations on interest cost. They'll never give you an interest rate because they don't factor it that way. They come up with other buzzwords, but you wind up paying somewhere between 45 and 75% APR, or that's percentage per year for the money that you get. And there's lots of tricks to that business that you can wind up falling into, kind of get dependent on it. And lo and behold, you might be paying 75 to 150% interest on the money you actually borrow for the time you use it. Um, I discourage you from ever doing anything other than hanging up on that um, call, that unsolicited call, or throwing away the mail solicitation you may get for cash advances. It's just not worth it. And they essentially will own your business by the fact that they get the money before you do. So I can answer more specific questions about that if you have it later. So types of financing products available. Well, products are intended to solve a specific financing need. So you don't go get a 25-year loan to take a vacation this summer. That's a good example to say the vacation this summer is a short-term need. You rent a car, you buy some plane tickets, rent a hotel, you go have a good time with your family for a week, and you come home and you pay that off over the next few months. That's a short-term use and a short-term repayment period. A term loan is talking about a specific period where you plan to pay back something over an expanse of time, such as an automobile. When I bought my first automobile, they used to make 3 and 4 year loans. Today, the quality of the automobiles are a lot lower, but the term you can get is a lot longer. So you might see 6, 7, 8 years to repay an automobile that will likely die within 5 years. Real estate is a better example. The company I work for, we do SBA guaranteed loans, and that can be obtained for a 25-year repayment term. And that makes sense because the structure itself has a useful life of more than 25 years. Your business, in all likelihood, may not occupy it that long. The average SBA real estate loan pays back in 8 years because people wind up selling their property, selling their business, and moving on and retiring. But it's 25 years to spread that cost out over a longer horizon, which helps your business. So you're not having to pay for it all up front, which means most people wouldn't own buildings. Lines of credit. Lines of credit are intended to be short-term uses of money that continues to replenish itself. So generally you would have a line of credit available for, say, $10,000. Maybe this is a Visa credit card. Maybe it's a home equity line of credit. Maybe it's an American Express time card. They have a limit, and you use them, and you pay the interest on them until you're ready to pay them back, and then you pay them back and they're still available, so that money just continues to regenerate as you need it later in your operating year or next year. This money is typically fairly expensive, but that's because it's short term. It's not intended to be something that you take out and sit there and pay interest for 5 or 10 years, because they'll make more money from your business than you do if that's what how you handle it. But it's intended to be for short term purposes. So you need to add some playground equipment kind of at the last minute in March and April, getting prepared for summer camp. And so you have figured out you need to spend $9,000 on a couple new pieces of equipment. You have that installed. You use your line of credit or your credit card. The summer camp enrollment shoots up. You start getting paid back extra money. You pay that line of credit back down, and in that at that point you have gotten three new pieces of equipment for your business as you return to the fall. And that is sort of where you place your product. If you choose to just make a small installment, over time, $150 a month or whatever their minimum payment is, and never paid another dime other than their minimum payment, most credit cards, that would be a 30-year term, because they will let you drag out repayment as long as you keep paying. And obviously, in that time, you've paid for that equipment 7 or 8 times. It's not worth it. Lines of credit are a good vehicle for a lot of specific uses that are short term, but so should repayment be short term. Equity. Equity is alluding back to that money where you use your own money. You invest in your own business. If you expect other people to make you loans and lines of credit, they want to know that you too have demonstrated your confidence in your business by putting some of your money into it at the beginning. And as you expand, being willing to continue to add more money to the cause. What am I talking about? Example, if you were to find a building to buy to replace the space that you're renting today, and it costs $400,000, well, the bank is not going to finance you for $400,000. It's more likely they're going to finance you for maybe 85% of that, which is to say, they want you to put $60,000 down toward that purchase price, and they'll put in the other $340,000. And in that way, you've put in 15% of the price, they've put in 85% of the price. Where do you get $60,000? Well, hopefully you have some personal liquidity from where you've been paying yourself a salary, you've been taking annual distributions, you haven't been spending all of it at the Keno table, you haven't been taking the luxurious round the world trip every year, and you have some savings at home that you're are putting aside for this purpose. Additionally, perhaps you haven't taken it as a distribution, but you have kept it in the business in account. You'll see in your equity section of your balance sheet called retained earnings. And there you just accumulate cash in the business and let it grow and save it up for that proverbial rainy day or for the day you have opportunity to expand. And from those two different sources, either personally or corporately, you come up with your $60,000. That is called equity. And it's very important to know when you decide you want to grow your business, anybody you go to for external financing is going to be looking for you to co-invest with them as a demonstration of your commitment to the success of that project and your willingness to show your faith in how that's going to turn out by putting your money on the line, just like you're asking them to put their money on the line. So equity, great source of business, great source of capital, and it's got the best price. Best of all, you're the boss. So you can make the decision on putting that money in and when to take it out. Other types of financing products available, again, bad money. I'm referring to those cash advance businesses that will give you this money. And I'll give you a brief example of how it works. I mentioned they are cash advances and they are looking for companies that accept credit and debit cards for payment for services. And so to make a decision. It really doesn't matter what your credit score is. It doesn't matter how cute your children are, how experienced and trained your staff is. What they look for and they'll ask you for are 6 months of your credit card statements from your credit card processor. And believe me, they can read those better than you can and a lot faster. And based on the average monthly income from credit cards, they have a formula as to what they will advance you for your business. They don't care what you use it for. They just want you to sign up and take it. One small rule change, though, they have is that they will tell you you have to use their processor exclusively. So maybe you are using ProCare to process your credit card payments, or maybe you're using the First National Bank of your hometown. That is not acceptable to them. They want you to use their credit card processor, which may be captive to their company like Square, and their processor enters into an intercreditor agreement with them. And it basically says that every Monday morning when you process, say, $6,000, $12,000 worth of payments for all those little babies that are coming in there to your center, before that money reaches your account from your credit card processor, they're going to reach in and snag 15, 16% of that money to make a payment on their account. Now, if you have a half week, say there's a holiday, this is maybe the week between Christmas and New Year's, and half of your children don't come in, and instead of getting $10,000 on that Monday, you're only getting $4,000 on the Monday, no problem. They're going to take 15% of whatever you get. If you have a big week when everybody comes back the first week of January and it's a $12,000 week, they're going to take 15% of that. So you might not think that's so bad. They're taking a chunk of your, revenue stream to pay themselves back. And if they were charging 12% interest, that wouldn't be so bad because they'd pay themselves back pretty quickly, like I discussed with a line of credit. But the problem is they use what's called an advance factor, which is very opaque, hard to understand, and intentionally so. And they will essentially, as soon as they advance you the money, let's say they're advancing you $25,000. Well, you're going to owe them, let's just pull a number out of the air and say you're going to owe them $35,000 to pay back. $10,000 to borrow $25,000, again, may not sound terrible if you've got 3 years to pay it. But the thing is, when they're snatching 15% of your revenue stream from your processor before it gets to you, you don't have to write a check. They just take it because the processor that they've selected is going to divert it directly to them. That's going to pay back pretty quick. So you might have actually paid that loan back in 7 or 8 months. Then when you say, okay, I borrowed $25,000 and I paid $10,000 for that, and it took less than a year to pay it back, do the APR calculation of that, the time value of money. You have just paid somewhere in the neighborhood of about 60% interest on your money. Now, it just sounds like, well, it's only $10,000. Well, in my world, it's 60%, which is eye-popping. And very often then, right when you get down to where you only owe, say, $7,000 back, they may come back and say, hey, how would you like to take another $25,000? And you say, sure, why not? I can spend it. And so instead of just giving you $25,000, they're going to turn around and pay off that $7,500 balance you have on the first advance and give you the net difference, which is $17,500. All the while, the value of that $7,500 that they paid off, their yield goes from 60% maybe to 75%. And you've just reloaded the card to have to start all over again for 25%. It's piracy, and you should avoid it at all costs, because no matter how desperate you are, some days for payroll, for whatever the expense is, you start a downward cycle when you start playing with bad money. So enough of that. I'll move on to the next topic. Lending terms you might expect. A legitimate lender, a bank, a individual, you may be borrowing money from the seller of your building to finance part of it, or a relative. You should have a defined repayment period. You want to know what their expectation is as how long will you grant me to repay this loan? And that's really the lender's decision. And if they're a smart lender, that's defined up front, just so everyone's expectations are set in stone at the beginning. So I mentioned the SBA program that my company advances in. We do real estate loans for 25-year terms. That's 300 months. That spreads out that payment over a long horizon, which helps you conserve cost. You're not having to spend, usually if you've been renting a building for $5,000 and you buy it, your loan payment may go down to $4,100 a month. So you've actually got more cash on hand because you have bought it rather than paying for it for someone else's ownership. But we tell you exactly how long you have to pay it back. You don't have to take that long. You can pay it back faster if you want to, but you know what the limit is. And what would be the opposite is someone lends you money today and you're thinking you've got a few months to pay it back, and they show up next week looking for their money. That's not very pleasant. So defined repayment period is something your lender should be telling you, and if they don't, you need to be asking them to be perfectly clear before you take the loan. How long do you have to repay it? Interest rate, fees, and other costs, very relevant. If someone just sort of makes money easily available to you, Uncle Joe says, here's $50,000. You want to know what's his expectation of being paid back. Is he looking for $50,000 back, or is he accruing interest at 5%, 10%, 18%, or what? Does he expect a loan fee? A loan fee is something entirely different. If you go to your neighborhood bank for a line of credit, they're liable to charge you an annual fee for that line of credit, maybe 1 or 2%. That's called a commitment fee. It's not unreasonable. It's the fact that they have to, in most, I mean, in all bank regulations, you have to have capital set asides for loans you've committed to. That commitment has a cost of money they have to have available to you whenever you want it. So they charge a fee to help offset that cost. And maybe there's other associated costs. If you are leasing a vehicle, you may have to pay some kind of an insurance rate through the leaseor. Or if you're buying a vehicle, you've got to pay license transfer, where they're going to be taking the title and moving it over to your name. If you're buying real estate, you've got to pay for an appraisal, an environmental search, recording fees at your county. Lots of different places with their handout, and the fees associated with these kinds of transactions are always going to be borne by the borrower. And while we're talking about always the borrower, I'll go back to interest rates to say, I field a lot of questions over the course of a year about how high is my interest rate? And oh my gosh, isn't that kind of high? I'd like to have a fixed rate. I'd like to have, a lower interest rate. Well, bless your heart, I understand it. Nobody wants to pay more than they have to. But in terms of how high an interest rate is, there's two factors that primarily make that decision for the lender. One is, what is their cost of capital? If they're having to borrow money from other sources at 3%, they can't lend it to you at 2% because that means their business model wouldn't work. They would fail. And likewise, the capital markets, you may recognize, have some variation on them. They go up and down depending on what's happening in our greater economy. What's the money supply? What's going on in Wall Street? How much competition is there for funding? And so they will set their rates based on the current market for rates. And while you'd like to have a fixed rate to know I've got this money locked in at 5% for the rest of my life, the problem is they are going to be locked into the cost of funds if they commit to you at 5%. So they've got to know that they're going to have money available at 2% for here to the rest of your life. And that's always more expensive money if you lock it in. So if you want it fixed, they're going to have to fix it, meaning they're going to have to pay more for that. And hence you're going to have to pay more for that. So today, we have a very favorable rate environment. You can get the maximum rate on an SBA guaranteed loan is 6%. That's prime plus 2.75% today equals 6%. For most of my career, and it's been way too long at this point, the prime rate was in excess of 6%. And today it's 3.25%. So you should borrow all you have. But if you wanted a fixed rate today, you might be looking at actually paying more than 6% for the privilege of locking that in and knowing that it's always going to be there. And while you think that might be comfortable, you might be disappointed because a study worksheet I put together over time shows that people who borrow on a variable rate basis with the rate floating up and floating down pay less interest over time than the average borrower with a fixed rate. So next lending term, you should expect collateral. If you're taking out a short-term line of credit, it's likely that you're not going to have any collateral requirements. They're going to make it to you just based on a revolving basis, and you don't have to put any security up for it. It's typically because that's such a small loan, it's just not worth the effort, and they would come after you for payment and sue you if you didn't pay them back. But they don't want to bother with all the messiness of getting collateral and having to keep up with all the documentation and then release it when you pay it back and so on and so forth. But now for real estate, that's different. That's a longer term loan. They're going to take the building itself as collateral. And so you need to know what the collateral requirements are. When they talk about, for example, real estate, you have to get an appraisal because they're going to make sure the building is worth what you're paying for it at a minimum. And they're going to lend you a percentage of that. So you may hear the term LTV, which is loan to value, saying that we'll loan you $600,000 to buy this building, or 75% LTV means that they'll give you 75% of that building. And if the appraisal comes in at 600,000 that you're paying for it, you're home free. If the appraisal comes in at 500,000, their loan amount's going to go down. And you have to decide, do you really want to pay $600,000 for a building worth 500,000? So that's all in the collateral area. When you talk to a lender, get their explanation of what's expected, what kind of advance rates do they have, and what are the due diligence costs associated with that particular kind of collateral. Finally, personal guarantee. I'm going to assume most of you have organized a legal entity to house your business, like a corporation or a limited liability company. You may even be a partnership. In all of those forms of organization, one of the benefits is there's no legal liability for the actions of the entity. So if people have a claim against your operation of your child care center, they have to sue the business because the owners are protected with a legal shield. Guess what? The lending world has figured out, there's a problem with that, in that sometimes people give up too quick and aren't really committed to working things out when the going gets tough. And so they get you as a condition of approval to step through that legal veil of protection and personally guarantee the money that they give you. In that way, we're all in it together, your business and you and the bank. Credit cards, you may have noticed, are never about the business. They may carry the business name on it, but their business name is never on it without somebody being the person named who's going to guarantee that loan, because they don't have time to be writing off millions of dollars for failed corporations. They're going to be expecting you to make good on it personally if your business can. So these are some of the lending terms you should think about as you look for third-party financing to put into your business, and have some expectation of what the requirement's going to be depending on the kind of credit facility that you seek to obtain. How do you prepare for all this third-party financing? What do you do to go and get approval and to get this money in your hot hands? Well, first of all, as elementary as this sounds, it might astound you to know how many people don't do this and how many, I'd say thousands of hours I've spent trying to get this information from people who really hadn't decided what they wanted before they showed up in my office and started asking for it. You need to decide exactly what you want to do, what you want to buy, where you want to buy it, and how much you can spend. Hint is how much you can spend is really dependent on how much can you pay back or repay every month. How will you use these money? Exactly. Not sort of, kind of, not maybe I'll do this, but the bank wants to know, what are you going to do with the money? And you better be pretty frank about it, because guess what? When we go to the closing table, we're going to spend it for you. Now, if that's a little line of credit for $10,000 that you get approved in the mail and the bank never doesn't know who your face is, they just see a name and a number and they can verify enough to give you a credit card, that doesn't really count. They don't care what you do with the money because it's not much. When you go in to borrow $2 million to buy a building and some land, well, they're going to gather up there and have a nice little signing ceremony, and you're going to sign 50 documents, and they're going to give the money directly to the seller of that property. You know, it doesn't even go through your checking account. And so when you talk about how you're going to use those funds, you need to be exact and have decisions made on your part. Most importantly, they're going to want to know, and frankly, you really need to know, how are you going to pay that loan back? Have you gained out what difference this expense is going to be to your business? How is it going to help you generate more revenues and, more importantly, more profits so that you can repay the money? Loans aren't repaid out of cash flow per se. They are repaid out of profits. So if the more and more you generate revenues every month results in you're losing more and more money, you have a business model property. And I hope you haven't borrowed money, because you need to be generating net profits, which are what is used to repay the principal balance of your loans. In that respect, you should game out the acceptable terms and conditions that you're likely to encounter on a loan that you want to create, and be prepared to walk away if you can't negotiate those terms and conditions. What am I saying? Well, let's say that I've described a 25-year repayment loan for an SBA guaranteed loan for to buy a land and building. But let's say you've been referred to Joe the money man down at the corner pawn store, and he says, yes, I will give you money for that building. I'll give you 50% of the cost, and you don't have to pay me until 3 years from now. Well, if you do the math, that means you're going to have to come up with a lot more money up front, plus you're going to have to pay back the other 50% a lot faster, which is going to probably eat up most of your cash flow over that period. In fact, your business may not survive just so you can pay for the building. You compare that to a term of 25 years and 15% cash down, and you can see the difference. And the exercise is sort of gaming out your acceptable point where your business can make that decision. Now, it won't be as stark as what I've described, but imagine this: you're in the search for a building to move your business into, and you know that if the price is 800,000, you're going to have to come up with $120,000 down, and your payment is going to be X dollars a month. Can you afford that? Is that 3 times what you're paying in rent now, or is it 1/2 of what you're paying in rent now? You may decide to think a little bit more conservatively. Maybe I should pull it down. I can't afford anything more than 600,000. So I'm only having to come up with $90,000 out of pocket, and my payment will be even less. And in that way, you get comfortable with what you can do before you've committed to do anything. And if after finding an opportunity to do that, if you can't get those terms, you know to walk away because it's going to lead to a bad situation for your business. The message in number A and B is just to be prepared. Don't walk into a bank's office and go into some stream of consciousness about what you've always wanted to do and you don't know how to start, but look for them to do it for you because you won't get the best deal for you. And it's not that they're trying to give you a bad deal as much as just you need to know what you want, what you're capable of before you go looking for it. Number three, anytime you're borrowing from an institution, they're going to need financial statements. It's a regulatory requirement and they can't do their job right without it. So if you're relying on tax returns to be your financial reporting, you need to step up to doing monthly financial statements because that's going to be required. Furthermore, for your own business advancement, learn how to read that financial statement. In fact, learn how to read that tax return more than just looking at the top line revenue number and the bottom line profit. Because on a tax return, that bottom line is actually taxable income. It's not a financial profit. A financial statement can give you everything that happened in your business over a particular period. And if you can't really read that with comprehension, you're not a great business person, no matter how much money you're making. Because if you're making great money and you don't know, you could probably be making even more. But we have to move on. You got a couple screens. I'm just calling free advice. Over time, aggregate lines of credit when you don't need them so you'll have them. What am I saying there? I'm saying that maybe right now you're not really looking to borrow. Maybe you don't have anything you need to buy. Now's maybe a good time to just go to American Express or Chase or Bank of America and just sort of give me a credit card. Let me just see what you'll do on my personal credit and my income. They may give you $10,000 and maybe give you $25,000. And hopefully you don't need it. Go buy a cup of coffee every couple months with it, pay that tab off, and just kind of keep it there in reserve. That's what you call a free savings account. It's liquidity you may need someday. You hope you don't, but it's there. Did I mention the umbrella story? A banker is a guy that gives you an umbrella when the sun is shining and helps you stand in the shade. But when the clouds come up, they want that umbrella back. And so when you need money, when you're in a desperate situation, when you've got payroll on Friday and you're broke on Thursday, don't expect to go to the bank to get the money. But if you had that line of credit while the sun was shining, you could pull out that $10,000 you're short, cover it right then, and worry about paying it back on Monday. Just a thought. Next, if it sounds too good to be true, believe me, it is. When you start getting these phone calls, people who are ready to hand you $50,000 and they don't know your name, it's too good to be true. And you don't want to pay it back. As if you haven't heard my bias already, last bit of free advice, don't be suckered into merchant cash advances or any kind of solicited offers to lend. You know, Wells Fargo, Bank of America, Chase, Citibank, they've been sitting down the street from you for years. Maybe you get a credit card application from them that came out from out of state 2 or 3 times a year. Maybe you've never heard from them. But then you've got somebody showing up calling about $250,000. Just understand uh, what they've got in store for you is something you don't need, and you should avoid it at all costs. Other last point, just you're in the learning business. You teach young children some very essential elementary points of life and how to learn from the age that they're turning over for the first time. You shouldn't be shy about learning more about the business of being in business, because you may be following your dream, you may be living out your passion, but you're in business and you're responsible for other people's payroll every week. And you've got to make 1,000 decisions every week about a lot of little things, and you're responsible for everybody that walks in your door. Understand the business side of that. I offer up this screen just to show you a book I published 8 years ago called Get Financing Now, that's got a lot of different uh, lending products described in detail. It talks about equity in detail and some basic financial uh, reporting information you should know about how to look at your own business. And it's available on Amazon.com. It's not the most interesting reading that'll keep you turning pages, but over the holidays, it could open up some light bulbs and help illuminate a more successful year for you. And with that, Donnie, I'm be glad to answer any questions if anyone's still awake.
I'm definitely still awake. I really enjoyed this presentation, and I actually can attest to the fact of taking offers from what you called bad money. Earlier this year, we do have a couple questions in the chat box, and I'll get to those in a second, but just to give my own insight into that topic specifically, earlier this year we had, my program takes, is like 80% subsidized care, and with that we get 2 payments a month from the county for children whose families can't afford tuition. And 1 month earlier this year, their check was late to us. So we were and we didn't have any reserves or savings lying around to cover our payroll. At this point, it was just like, as we were getting money, we were spending it on payroll and all of our other expenses. And we were scrambling around at that point, trying to figure out how we were going to cover our payroll, because we didn't want to be in a position where we had to tell our employees they had to wait for their paychecks. So we've never done that before, and we didn't want to start that day. So we saw something on we use a payroll service called Paychecks. For those of you that are not familiar, and they were promoting this, what I think is now a merchant cash advance company, and we kind of signed a deal with them to take money for a few months and pay back way more than it really wasn't worth it. I would have rather just waited for the check than to spend as much money as we did. So I think that was really good advice. But I'll get to the questions. We have the first question that I see is, what are the benefits of applying for an SBA loan at Harvest instead of directly with the SBA?
That's a great question. And the answer is very simple because the SBA doesn't make loans. Notwithstanding disaster loans and notwithstanding the Triple P program, which was an initiative designed specifically for the pandemic, under the 7A program and the 504 program, the SBA doesn't lend money. You access their program through the lender, who goes to the SBA and gets a guarantee approved based on how they have qualified you, the borrower. Mm-hmm. So, Harvest, and there's about 300 SBA lenders across the fruited plain that account for 85% of all the SBA loans made.
Okay, got it. Shanique wants to know what government funding and educational grants are accessible to startup childcare services. Where can new childcare providers access applications for grants?
Tough question in that, a little, I guess, sidebar. Typically, grants are associated as monies that are available to a not-for-profit business and someone who is fulfilling a social mission in alignment with the grant maker. So in our community here, United Way supports some childcare centers, like particularly Head Start. And there may be DECAL, our state authority, has some grants for very specific purposes for children, for centers who do accept a lot of subsidized children that have supplemented this year because so many people have disappeared from centers. But typically, a for-profit business, it's very unusual that grants are available to them. To start a business is the toughest capital to get because it's just higher risk. And most people in the volume capital business, like uh, Harvest, for example, would look at a childcare startup if they were buying a building up front because that lowers the risk and that there's collateral, and they're an experienced operator. So they've had years of demonstrated service of what they can do. What's preferred is they may be renting somewhere and they've demonstrated they have a company and an enrollment and families, and they're just going to move across the street or down the street into a building. Those are simpler to do, which is more of an expansion. But startup money is it can be done, but it is challenging. Just know.
Yeah. Okay. And someone wants to know if you go through Harvest for a loan, do you need to submit a business plan?
The only requirement in SBA lending for a business plan is if you're buying another business that's already operating. So, Donnie, if you were selling your business to someone and they're getting an SBA loan, they're supposed to have a business plan to explain how closing your business and they're starting their business in your place is going to transition, and why you think you can succeed, and to have all the demonstration through the plan that you've done your research, you know that marketplace, you know the teachers, you're ready to go. I advise anyone that'll listen in my client list that the business plan shouldn't just be prepared when a lender asks for it, because the person who can benefit the most from a business plan is you, the business owner. And even if you don't plan to borrow money, a business plan is an excellent idea because it records a set of facts and conditions in place at one time, with the idea of projecting forward your budget, your operating plan, and where you intend to go on your horizon forward for the next 12 months. So
Mhm.
it's a roadmap you create for you for your benefit. The fact that the lender wants to see it, that's good and fine, and it'll confirm to them that you know what you're doing. You've stopped to think through it. I've never written a business plan where I didn't think of a half dozen things that I needed to do, or that I should do, or that I wanted to do, that I just hadn't thought about. I hadn't stopped to think about it until I committed myself to writing a business plan. It doesn't have to be 200 pages. It doesn't have to be 30 pages, but it is best built out with you telling your story to you and deciding where you want to go and committing it to writing. And then next year, you know, no foul if you haven't gotten there or if you changed your mind mid-year, but you review that plan and you re-up it to look for the next year. It's just good basic planning that too many small business owners overlook, and they just head into things off the cuff, and they're like riding into town shooting your pistols off without really aiming it at anybody, and that's what happened. If you have a goal where you want to go, and you've committed to that, you've thought through it exactly the steps you're going to take, you'll get there more successfully, and you'll earn more from your business and grow faster.
Yes. Okay, I agree. And someone, Paula, wants to know, do you recommend that you pay for accounting services to handle accounting for your business? Will that help her to get ready for a loan?
If you understand bookkeeping and you have a good program, I am personally, I can't stand QuickBooks. And although I tell you that I'm partners in an accounting business on the side that uses QuickBooks for all of our clients, which
Mhm.
helps me really not like them more than I didn't like them before. And frankly, I've taken accounting in college. I've been dealing with numbers all my life, and I'm actually think I'm pretty good at it.
Mhm.
And I can't navigate QuickBooks alone. It's very confusing to accountants, not just to us lay people. If you can do that and still run your business, then that's fine to do it yourself. In that it does save a little money and you are more connected with your numbers that way. But understand that's not a sit down one Sunday afternoon a month and pile it all in there. That's a like ProCare. It's dealing with it every day. You're putting in entries, you're updating at least weekly so that you don't get behind. Using an accountant would be a second set of eyes on your operating numbers and allow you to do what's really more important in your business, which is to generate revenue. It's to make sure you are getting new people in there to fill your empty seats. You are collecting the revenue for the people that have enrolled with you. You're managing your labor so you don't have people sitting around idly on the clock when everybody's gone home. And that's a full-time job, as all of you know better than me. So having an accountant, working out an arrangement and understanding what the cost is, and getting at least quarterly financial statements, if not monthly financial statements, and make a one-time investment after you've read my little $15 book to get that accountant to help you understand the output. When he gives you a financial statement, whenever you've asked for it, monthly or quarterly, sit down with them and have them explain it to you. What does it mean? How do you interpret the results? And then as you begin getting more conversant with those statements and your eyes recognize those different account numbers, you'll have a document coming out regularly that you can review. How am I doing? Donnie, a parallel story I tell about this is maybe somebody wants to guess on the chat box. What is the most common surgery performed in the United States today? Does anyone have any idea? The most common surgical procedure.
If you know, put it in the chat box. Someone said heart surgery. That's what I was going to guess.
Hip replacement.
Hip replacement.
Who knew? But when you go in for an annual physical, what's the first thing the doctor does? Do they say, let me look at that hip? No. Maybe if you're limping, they will. But their first thing they're going to do is they're going to put you on a scale. They're going to look in your eyes. They're going to take your temperature. They're going to check your blood pressure. They're going to listen to your heart and your lungs as you inhale. They're going to check your blood pressure, your pulse, your temperature. Why? Because these are the basic elements of where telltale signs start showing up that something could be wrong with you in a number of different places. It's not the hip. And that is intended to just say the financial statement is really where you understand what happened. Yes, you've got $12,000 in the bank. Yes, all your bills are paid. You've got no debt, blah, blah, blah. Where did the money go? When you really observe this period over period and start understanding what it's costing you, you start figuring out where money is bleeding out of your center that doesn't have to. You start thinking about efficiencies, and very important, you start comparing. If the average childcare center in this nation is spending 50% of its revenues on labor, why am I spending 54%? If they're spending 7% on food costs, why am I spending 12%? And these questions will lead you to answers that help you operate more efficiently and leave more dough in your retirement account, or provide more equity for you to then go and expand your business by buying a second location. So that's a long answer to the question about an accountant, but accounting is very important. The metrics of your business is just like going to the doctor for that checkup. It's where you get to be the doctor of your own domain.
Right. I definitely agree. And I have had experiences in the past as well, where when I first opened my first childcare business, I did not have an accountant that I was using regularly. And I found myself in a lot of trouble with taxes because I didn't know what I was doing. So that's another reason to make sure that you have a second pair of eyes. Like Charles said, I had to pay back penalties and stuff regarding payroll taxes. So it's important that you have someone that's an expert in that field. But with that, we are out of time. Charles, I see that you have your contact information still up on the screen. Is this how people can get a hold of you with their questions and if they'd like to use Harvest?
Absolutely. Or if you just have questions, I've made a career of helping a lot of folks through my books and lots of webinars and articles and such. If anyone wants to email me with particular questions we didn't have time to get to, I'm happy to answer them. I will send out a copy of this presentation notes back to you, Dani, to distribute as people may want it for
Yes.
reminding them of what we've talked about.
Okay.
And if someone is looking for to buy another center or to upgrade the facility you have, I'd be glad to try to help them work through that.
Okay, that sounds great. And yes, as soon as I get it, I will send it out along with the replay. Charles has also asked me to send him questions that were not answered, and there are a few, so I'll send that over to you, Charles. And if I will also put your email address, if you don't mind, in case people, because I don't see it on the slide, but in case people do have questions, I will add your email to the replay with the PowerPoint.
That's fine, sure.
Okay. All right. Thank you everyone for watching, and thank you so much, Charles, for being here tonight.
Okay. Have a nice evening.
Thank you. You too. Bye-bye, everybody.